Hi, this is Raghee, and today's topic for our free nightly video for TradeForexFutures.com is about chop and slop, and that is that market environment where when you step back and look at the directional bias as reflected on the daily time frame, we just see a market that's either in transition or a market that's stuck in a range. And we have examples of both here. We're going to crisscross from the futures markets into the forex markets. Again, kind of take that for extra tact where we want to assess the risk environment, and then take that knowledge over to the forex markets, all while keeping a one mind many markets approach, which is the marketplace is our playground. And if we understand what price action is communicating to us about psychology, we really can trade any liquid market. Okay, so let's start off with what's happening on the Dow. Now, this is one of the things I talked about in the chat room. And one of the things I'm super excited to be able to tell everybody, little house cleaning here. A couple cool things that we have coming up for the end of this month and going into May. I don't have the exact dates, but I am told by the staff that this is going to happen. I'd say 98%. Okay? So we're going to have a chat room for Trade Forex Futures in the morning that will run about 90 minutes. And you guys can sit and ask me questions. And then we'll get into an hour of market analysis. And this is going to be every day, Monday through Friday. Super stoked about that. The second thing is I'm working on an ebook called Before the Trade. Before the Trade. And I'm super stoked about that. That is going to be an ebook that's going to be available, I'm hoping, by probably the first week of May. I've told my mother I'll have it ready for her birthday. Her birthday is May 3, so that gives you an idea of what I'm shooting for. So we have a lot of cool things in the works over at TradeForexFutures.com. Back to our topic here. What do we do with chop? You know, here is an example of a market that had been in an uptrend. You can see the consistent green grab candles and the 12 to 2 o'clock angle of the wave. And then what happened? We broke the dynamic support of the wave, okay, right there. So that took us from what was an uptrending market, right, to more of kind of a neutral market. And then we were looking at the beginnings of maybe a down market. But in the meanwhile, that break of the uptrend, and here's a trap that a lot of traders fall in. They are either wanting to be bullish or bearish, when in reality there are times when we shouldn't be either, because neither is in control of the market. And this is exactly one of those times. We're looking at a Dow. We're looking at a risk environment where there is not a clear picture. And some of you might say, Raghee, here we are with basically what amounted to, as we're closed today on April the 17th, a Dow that closed up a significant amount. Where do we end up closing on the Dow? Take a peek. Here is the DJIA, actually index versus the YM futures contract. There is our update today in the Dow. We closed up 194 points today. Okay, again, this is the DJIA, the actual Dow Industrial Average. Let's jump back and over to the futures. But how can I say we're not going anywhere? You know, yes, we had a tremendous single session, but step back and look at the range that this market seems to be contained by. It's like having a giant fence. You know, yeah, you can roam around a lot within your property, but at some point you're going to hit this fence. And this is an electric fence, okay? When you hit it, it's like, bzz, you know, there's not a lot of ability to get through it, okay, in either direction. Why? Well, in terms of the market environment, this is a market where we're typically going to exhaust as we reach the extreme highs and the lows, because we don't have that organization of sentiment and momentum to carry us out of it. Sure, it's one thing to have an up day smack dab in the middle of it, because we have plenty of room to run. Okay, there's plenty of room to move. Actually, truth be told, there's plenty of room to move in either direction. Okay, so keep that in mind. But the bottom line is we are contained within this range, which means we're going to have to expect exhaustion as we reach the extremes. One of my tools, the 34 EMA wave, coupled with the grab candles, together they really are telling me that there is no organization of sentiment and momentum in this market. I don't have a 4 to 6 o'clock angle that is established, giving me a downtrend. I no longer have the 12 to 2 o'clock of the uptrend. and I'm just kind of chopping about in what I call a 2 to 4 o'clock angle. What do we do in these environments? Well, you notice I've got the stochastic working underneath here. Let me show you what I've got working as far as the stochastic goes. Let's set this up fresh so you can see what I'm doing. And here we go. So you'll see here I've got a 21.33, a fairly slow stochastic, a fairly slow setting, and quite smooth, as you'll see. So take a peek, and this is what it looks like. Now, what this does for me in a choppy environment, I want to mention something really quick. Look at this section in time right here. Okay, and this isn't specific to the Dow, by the way. This is all about the underlying psychology of a market. Take a look as this market was heading up. Okay, now at no point in time in an uptrend am I going to look at a market that is overbought. It might be overextended, it might be accelerating very quickly, but in an uptrend, we expect higher highs and we expect higher lows, not any kind of assessment of an overbought. Yet look at my stochastic for a bulk of the move. It really persisted in an overbought area. Okay, so in a trend, a stochastic really is just going to peg at being overbought, when in reality, that's really not the tool we should use within the context of a trend. Is an uptrend overbought? No, not at all. Because we are expecting higher highs and higher lows as the psychology is bullish. That's the basis of the move. But once we lose the uptrend, once we stop printing consistent green grab candles and lose that 12 to 2 o'clock angle of the wave, then at that point we can start to look at our stochastic, because now the stochastic is in its element. When we transition, at some point the overbought is going to be correct, because as we transition there's got to be a high put in. So there's my overbought and there's the high that was put in. But notice we had overbought here as well. We had overbought here as well. So don't say, okay, the stochastic was right, because in reality it wasn't. It just finally became right when the market finally did exhaust. So I don't want you thinking that, oh yeah, it was right. I just want you to see how many times it was wrong along the way. Okay? So it's the environment that's going to dictate what kind of indicator I'm going to use. And notice, again, this is a sideways environment. I'm going to use an oscillating indicator. In this environment, I really don't find anything better than a stochastic. I know some people might like an RSI. That's fine for me. I like the visual of that overbought 80, oversold 20. So what I'm looking at now is a market that's likely to continue to move within this range, triggering the support as we approach the range lows and the oversold, and triggering the overbought areas as we get to the range highs and the over 80 area. Okay, that's the way a market will move. So for those of you that are curious, how do I deal with, what's the strategy for a choppy market? I'm going to tell you first and foremost, when you have a daily time frame that is chopping like the Dow, and let's transition over to another market here real quick. Let's bring up the Euro US dollar. When you have a market that does not have a directional bias that is trending like we see on the Euro US dollar here, what you want to remember is that the market is confused. This is a psychology where neither the bulls nor the bears are really in control. There's a lot of volatility. There's volatility in the sideways range. Now I want you to notice a subtle difference between the phase here on the Euro US dollar, which is range-bound chop, versus the transition we saw here. This is not an established range yet, is it? Like that Euro US dollar daily. This is a market that recently rolled over and is in transition. It's kind of a fresh look at that chop versus the established chop of the fiber, of the Euro US dollar. But the same tool applies. We're looking at a market where we expect there to be exhaustion at the extremes of the range, and we'll chop around. When we're in this sideways 2 to 4 o'clock angle, what I then want to do is decide one of two things. One, do I even want to venture into a pair where there's confusion? Because the better, clearer market psychology comes from one of the groups, bulls or bears, in control. No one's in the driver's seat here. Okay, how does a car drive when no one's got a grip of the wheel? It's going wherever it's going to go, right? That's kind of like what the markets are like when there's nobody in the seat. I don't care if it's a bull, I don't care if it's a bear, but I want someone with a grip on that steering wheel in that seat. Nobody's here, so we're just kind of going to meander around within this wave, kind of bouncing within the extremes of it. But the oscillator, the stochastic oscillator, is the tool I will use if I want to trade what I call inside the range or distribution fades. So it's not my preferred way to go. My typical way to tackle a market that has a daily directional bias of chop, like we see here, is to retreat to the shorter term time frames. So that's how we deal with this kind of chop and slop. So what I'll do in this environment, in this chop, is recognize the 2 to 4 o'clock angle, then go activate my stochastic, and if I want to play the chop inside, the setup is there. However, what I can also do as a way to gauge the intraday, the shorter term time frames, is respect the ranges, the extremes of the range, and look for when the market might be at turning points within the range. So either way, it's going to be a little tricky. And I will never say that if you want to leave a choppy daily chart alone, or even that entire symbol for that matter, that's absolutely fine with me. There will be clear, better setups when the market is in a more established trend. Contrast this view, by the way, with, for example, and I'll leave you with this chart here, the Aussie US dollar. Take a peek. I think that positioning yourself in a trade in something like the Aussie, where there is a more concerted, organized, bearish opinion. This is volatile too, right? But overall, we're very bearish. Overall, the dominant psychology is going to be selling pressure at some point when we start to move up higher. I find the environment where you know that the bears are in control, like in this example, are going to be clearer to find your trading opportunities because you know who's in the driver's seat, okay? All right, that's kind of a lengthy free nightly video for tonight, but we got a great question that came through to our customer support staff, and they're great about relaying those to me, and that was what basically was the topic of today's video. So I hope it was helpful, hope it got you asking some questions, and I hope you'll start with this daily time frame and begin to ask yourself, who's in control here? What's the dominant psychology? And you can also therefore understand when you are trend following versus counter trend trading. All right, members, we will take a look at the individual trades within a lot of this chop and slop in the members area. See you there.